Now, gharar, as we talked in the workshop, basically zero-sum game that create no wealth. So one might argue, well, it creates no wealth, but it might not destroy wealth. This is not true. Although it is at the micro level, it is zero-sum, at the macro it becomes negative sum. Because, and we will see how this happens. Why? Because if we allow zero-sum games, we allow side bets. We allow that 100 people would bet on a single stock, for example, or a single loan, whether this loan will be repaid or will be defaulted upon. So if you have 100 people betting on the same loan, if that loan get defaulted upon, how many people would lose? The bank plus at least half of those who are betting, because those are betting, half of them would say he will pay, half of them say he will not pay. So 50 plus 1, you get 51 people losing because of a single event. So side bets creates or multiply the losses. So ultimately you get, it's just like a game. If you have two players, the winner, the loser would pay to the winner. It's a loss by a single person. But if you have the viewers, those who are attending the game, also are betting on who's gonna win and who's gonna lose. In this case, the loss will be multiplied times the number of those who were betting against that loser. So you see how these side bets will multiply the loss, and therefore at the macro level you get a negative sum game. Derivatives 600 trillion and growing, by the way. Keep on. No matter what asset you look at, the growth of derivatives surpasses all assets. No other asset have grown with with these rates. Now, credit default swaps is a certain kind of derivatives. Many of my colleagues have discussed it and point to it. It is a semi-insurance contract, but it has two components. One is the insurance, that the lender is able to shift the risk of the loan to someone else. The other aspect is that it is a side bet also. So the first element that these credit default swaps contribute to the crisis is that lenders are not responsible anymore for the default of the borrowers. You give a loan, no matter what you do with this loan, no matter how many times you sell, ultimately the risk of the loan is sold separately to an independent party, either to insurance companies or to hedge funds. So ultimately, the debt holder, the one who holds this debt, the lender, is not responsible. He's not taking any risk. And therefore, why not to lend more? Because by extending the loans, you are taking fees, and fees from selling the debt and all these sources of return. The risk is taken by someone else, either by insurance companies or by the hedge funds. So without responsibility, all lax and reckless behavior started to appear, and economists know this very well. It's moral hazard. Every economist is aware of this. So the question is, why would those insurance companies, AIG and other hedge funds, why would they accept to take that risk? I mean, they are not dumb, of course. They must calculate it. And the answer is very simple. First of all, they get fees, upfront fees. And if you are selling huge credit default swaps, you will be getting a good amount of cash. And for managers, their bonuses depend on cash, on income. And therefore, they are getting immediate return, while the liability is shifted to the future. As long as no crisis is hitting, you are fine. You are getting cash, you are getting income. The other factor is that house prices have been growing steadily from 2000 and on. And if house prices are rising, there is really no risk of default. If the borrower is unable to repay, you simply sell the home for a profit. So there is no risk. For those insurers, so to speak, those sellers of these credit default swaps, they are practically taking no risk as long as house prices are going up. And if you allow me to move quickly to another slide. Okay. This graph shows the prices of houses. I don't know if you can see it or not, but anyhow, the presentation is on the PC. Anyone who wants to look at it is there. Have been growing at double digits. So if the prices are growing of houses, you really don't worry. You are not worried at all. So you are willing to sell insurance. And the third factor that allows those insurance companies to take the risk is that they can sell the risk to someone else. If I'm an insurance company, I take the risk of this borrower, I can go next day or next hour and sell that risk if I would like to. And therefore there becomes a market. The market for these risks, the market for credit default swaps, have grown huge. From almost practically zero in 2000 to more than 62 trillion by the end of 2007. Now it is less than 55 trillion. But by the end of 2007, more than 62 trillion. 8 times, it had doubled 8 times within less than 6 or 7 years. Why? Because the bigger the market for risk, the more it's easy for those insurance companies and hedge funds to take the risk. Because if I take the risk of this borrower, I can turn to the market and sell that risk to someone else. It's easier for me to take the risk.